A flat line in tech earnings is whispering that the AI rally may have developed a fever. Shares of SpaceX and AMD both sank despite beating expectations, revealing cracks beneath glossy revenue numbers. The portfolio needs to know whether this is a temporary cold or cardiac arrest before loading more exposure into semiconductor names. The indicators are cooling off after last week's overheating. S&P 500 shed 0.17%, while Nasdaq coughed up 0.83%. Spec leaders like ARKK barely twitch at 0.11%, proving that retail enthusiasm has flatlined into apathy. The data is screaming, capital rotation is complete, and smart money is pulling back from overextended positions before the next respiratory illness hits. 10-year treasuries ticked lower at 4.62% as yields find resistance, a healthy cardiac event that signals buyers are defending against further tightening. The consensus among the Canary community is clear. Credit conditions remain stable, but duration stretching beyond 3 months now carries infection risk from geopolitical overhang. Our metrics confirm the pulse is steady, but barely beating above normal ranges. UVX smashed 4.17% as VIXY and VXX all cooled together. Fear has exhaled for the first time in weeks. The Canary dashboard shows a paradox. Portfolios are hedging less aggressively, while underlying fundamentals deteriorate faster. This is classic pre-infection behavior, where organisms forget to build immunity until symptoms appear, then panic buy protection at peak prices. Consumer staples quietly absorb demand as XLP and Disgyan held steady. Households still buying coffee and ketchup despite the tech crash. Price hikes on electronics becoming permanent means inflation is structural rather than cyclical, which extends the runway for defensive positioning. The real economy isn't burning. It's just running hot enough to warrant cooling measures before a system-wide shutdown. Gold surged 3.76%, while GLD climbed 4.31%, exposing the portfolio's vulnerability to geopolitical flashpoints rather than pure earnings weakness. Bond barely moved at 0.03%. Duration is no longer the hero it was in early Q2, but gold remains the ultimate antivirus for systemic risk. The data indicates safe havens are pricing a worst-case scenario that includes both inflation persistence and credit tightening simultaneously. The portfolio faces its greatest test since April. Tech earnings proving resilient while macro fundamentals deteriorate faster than anyone anticipated. Gold's surge combined with fading VIX volatility means the market is transitioning from greed-driven speculation to fear-based hedging, a dangerous phase where defensive assets outperform but create false comfort for overexposed positions. The villain today isn't inflation or rates. It's earnings quality degradation masked by AI hype that will only reveal itself when quarterly guidance drops below consensus. The Canary verdict is clear. Reduce tech exposure to single-digit allocations and let gold absorb the geopolitical risk premium until VIX stabilizes above 18. The fever of speculation has burned through the easy gains, leaving only institutional quality names with genuine moats. Not AI concepts trading on momentum alone. Stay flat until the respiratory illness clears. Your portfolio will thank you when the next cough hits harder than this one.